Welcome back, everyone. Today on the Joseph Carlson Show, the stock market is taking a nosedive. All three major indices are well within the red. In fact, the NASDAQ is down almost 2% today because of a downgrade on the US national debt. Fitch is one of the major credit rating agencies. There's typically Moody's, and then there's S&P Global, and then there's the little bit smaller one, Fitch, that sometimes gets left out, but Fitch is downgrading the US national debt from a AAA rating to an AA+. And this has made a lot of people upset. Some people are upset because the market's going down and their favorite company they're invested in is going down. The White House is upset because they don't want to downgrade on the US national debt while they're in office. So White House representatives has said that this is baseless and senseless. But I have a different opinion on this. I think that this downgrade is not only not baseless, it's not only not senseless, but it's appropriate. The US has an issue with debt, and it's time for people to come to the realization of that issue. So in this episode, I'm going to be giving a different perspective. We're going to be looking at the US national debt as if we're investing in a company, doing analysis on the balance sheet. Now, of course, there's some other exciting news today. We have Starbucks that recently reported their earnings report, and it's having a nice bounce today. Starbucks is up nearly 3% in a blood red day after reporting their earnings. We have the results here as well as all of the numbers, so I'll be giving you my opinion on Starbucks' earnings. And then, of course, we also have VICI. This is one of my core positions. It makes up over 10% of my portfolio. This company recently reported earnings, and in the earnings report, they dropped the very important news that they're investing in wellness centers. In specific, they bought in to a premier wellness center called Canyon Ranch. We're going to be looking into Canyon Ranch. What is this place? What do they actually do? I've never been to Canyon Ranch, so I want to find out why VICI, one of the companies I own, is making investments into this place. But then we also have some more VICI news. Blackstone, we know, is selling off the Bellagio. The Bellagio is one of the most iconic pieces of real estate in all of Vegas. VICI would be the natural buyer. But after listening to the earnings call, I no longer believe that VICI is going to buy the Bellagio. And I'll be playing the clip in particular from the earnings call of why I think they're going to avoid it. Now let's go ahead and jump right in. Currently, my portfolio is down 1% on the day. It's down $5,000. So this is a big impact for a single day, but it is holding up better than the NASDAQ, which is down nearly 2%, or even the S&P 500 down 1.2%. The main reason the stock market's down today is because of this downgrading from Fitch. Now, what I've seen online is most people's reaction to this is that it doesn't make sense, that Fitch is just trying to make a name for themselves. In fact, there's an analyst that went on to CNBC that literally said that Fitch is vying for credibility. So Fitch is doing this for selfish reasons. They're not giving a normal rating on the US debt based off of the facts and data. They're just doing it for themselves. There's a lot of people questioning the dubious motives of Fitch. Why would they downgrade the US debt? A senior Biden administration official said the decision was bizarre and baseless. Bizarre and baseless for Fitch to make. So let's go ahead and take a look at how bizarre and baseless this decision was. In Fitch's view, there has been a steady deterioration of standards and governance over the past 20 years, including on fiscal and debt matters, notwithstanding the June bipartisan agreement to suspend the debt limit until January 2025. The rating agency said. So the first claim that Fitch makes is one of governance. They're saying that over the past 20 years, the way that the debt has been handled between the politicians has not been good. It's been deteriorating. And that is objectively true. Every 8 years that we run into the debt ceiling, inevitably there's this big partisan political battle where both sides stuff as many things as they can into the deal, both increasing the amount of spending and the rate of spending until they finally come to an agreement at the 11th hour. Meanwhile, the debt holders are wondering if the debt ceiling is going to be raised or if it's going to be blocked, if they're going to get paid back on their money or not. And it would be very difficult to argue that this instills confidence in the debt holders. The U.S. Treasury Secretary Janet Yellen disagreed with Fitch's downgrade in a statement calling it, quote, arbitrary and based on outdated data. Now, of course, she doesn't agree with the downgrade. She is the Treasury Secretary that's receiving a downgrade. That is a little bit of an indictment on your job. The Treasury Secretary is supposed to be over this type of stuff. So Fitch is basically saying that right now, you're not doing a great job. And she's saying, nope, I disagree. I'm doing a wonderful job. Now let's go ahead and take a look at this so-called outdated data. Another thing that Fitch highlights is the government deficit. There's two different important numbers when looking at the national debt of the US. There is the amount of total debt the US has. That's this number that's going up rapidly over time, that is increasing at an incredible pace. In fact, because of COVID in 2020, the US national debt jumped from $23 trillion all the way to $31 trillion currently. We tacked on nearly $8 trillion within a couple of years. This is just the amount of total debt. Then there's the surplus or the deficit. Because there's rarely ever a surplus, we usually just refer to the word as deficit. That's basically all I know since I've been alive. The deficit means we're spending more money than we make. When we spend more money than we make, this line goes underneath the horizontal black line. That is a deficit. And the faster we spend money, more than we make it, the greater the deficit. We can see that through the 1980s, we had a little bit of a deficit, only a couple $100 billion per year. This was concerning at the time, but it didn't seem like it was too bad. It was a concern, something we were looking at, but it wasn't too bad. Then in the early 2000s, it actually turned into a surplus. We cut a lot of programs, we cut a lot of spending, and we had for just a brief amount of time, a surplus. Then we got back to a deficit, then we tried to make a little bit of gains in a surplus, but we never quite got there. Then the recession in 2009 caused the deficit to be enhanced. We had a $1.4 trillion deficit. Then it continues on. We're in the red this entire time. And we can see what happened during COVID. The deficit exploded as we gave out record stimulus. And then the deficit obviously bounced back once we discontinued those stimuluses. Now, what the current administration and president is doing is bragging about the progress made on the deficit, going from this low mark here to this mark here. This is a reduction in deficit. But when you look at the overall picture, the situation we're still in currently is a massive, almost record-breaking deficit. We're still literally at the worst level we were 10 years ago during the Great Recession. That's how bad the deficit currently is. The increase that we've had in overall debt in just the past couple of years has surpassed anything we've seen in history. The US is tacking on more and more debt at a record pace. In the past 9 months alone, we tacked on another $1 trillion in debt. This number continues to increase at an alarming pace. So when I see the Treasury Secretary say that this downgrade is unwarranted, it's based on arbitrary and outdated data, that doesn't give me a lot of reassurance. All the data that I currently see, even the updated data, is alarming. Now there's a lot of charts we can look at, but there's one measurement of data that's the most relevant to this discussion of whether or not the US has too much debt. When Warren Buffett was asked about the US's national debt, he gave one ratio that he thinks is the single most important one.
There's the ratio of debt to GDP. There are a lot of measurements of how much debt is too much and all of that, but probably I think that if I had to look at one single statistic, I would look at that ratio of just like I would look at a ratio of debt to income.
Out of all the statistics, debt to GDP is the number one that Buffett would look at. So we can take a look at this measurement and see how it's doing. Well, if we look at a broad history over the past 35 years, we see that it's at the highest level ever recorded. In fact, right now, it's just down from the peak of where it was during 2020, the COVID peak. So it's gone down ever so slightly, but it's still at 118%. This is the same level of debt to GDP that the US was at during World War II. So we are pushing the limits of historical highs of debt to GDP. Now, I don't know when things will break. I don't know how high debt to GDP has to go before we run into serious issues. But I think it's wise to stay far away from that limit. The more we can get debt to GDP down, the better. And in the meantime, I do believe it's appropriate for the credit rating agencies to give some warning, to slightly downgrade the US until the US improves these ratios. Now next up we have Starbucks reporting earnings yesterday. Initially after the mixed results from their earnings report, the shares traded down. It was in the red on the day yesterday, and then for whatever reason this morning the shares launched up 2.65%. This is why I don't think it's wise to pay too much attention to the immediate trading after an earnings report. It's typically not a great reflection on how the business fundamentals are actually doing. But we have all the data here already in Qualtrim, so we're going to be going through Starbucks and doing a bit of analysis. Now, one thing I want to do is, since we're in a red day right now, I want to flip this over to dark mode so we can check out Qualtrim Insights in dark mode. And just a side note, if you have not tried out this software, I think it's time to try it out. We're at the very start of the month, so if you join today, you'll get a full month free trial. There's no risk, it's cancel anytime. You can gain access to trying out this software today by joining the Patreon. There's a link in the description of this video. So let's go ahead and dive into the numbers. Before we get into these charts and the latest quarter of data, I just want to go over some highlights from the earnings report. We have at the very top their biggest highlights, the things Starbucks wants you to know. The Q3 consolidated net revenues were up 12% to $9.2 billion. Now it's hard to give that context, so let's go ahead and take a look at it on the graph. Here's Starbucks' revenue, and here's the last quarter, $9.17 billion to be exact. That's a very good quarter from Starbucks. This company is seeing very strong, consistent revenue growth. And if I'm looking at this, I'm seeing linear growth over time, which is exactly what you want to see as an investor. Almost every quarter, quarter over quarter, the trend continues of Starbucks growing around that rate of 10 to 12%. A lot of people don't believe that these type of companies will continue growing above 10%, but these type of compounders continue to grow at these great rates. Now moving on, we get to the comparable same-store sales. When I'm looking at investing in Starbucks, the same-store sales is one of the most important metrics. They already have so many locations. Starbucks has 33,000 individual locations. So one of the major ways they grow is by growing same-store sales. We see that it's up 7% in North America and 24% in international. Now, if we looked at their earnings expectation, this was actually considered a miss. Starbucks missed on their revenue estimate, and they missed on their same-store sales estimates. That's still very solid growth. I wouldn't be concerned at all if I owned this company right now. Now, one of the main things I focus on with these type of companies, whether you're looking at Chipotle or Starbucks, these are companies that have strong loyalty programs. They have memberships in their apps, and that drives a lot of their digital business and their business overall. Starbucks has now 31.4 million users of their app. That's up 15% year over year, which is very fast growth. Now, this is a bit below where I expected it to be. I wanted this to come above 3.14 million, closer to 3.2 million, but it's still growing steadily and headed in the right direction. Now, if we dive deeper into some of the fundamentals here, we can take a look at the EBITDA of the company. The EBITDA is steadily going up as well. That's something I like to see. We can look at the free cash flow of the company. This is how much cash the company's making after their CapEx investments, which for companies like Starbucks is primarily opening up new locations. The other thing that can impact the free cash flow is the stock-based compensation. So I have a chart here where we can look at that as well. In the case of Starbucks, their stock-based compensation is pretty low. On a free cash flow base of $2.43 billion for this quarter, stock-based comp was only $228 million. So when we net out the stock-based comp from the free cash flow, we get a real free cash flow of $2.2 billion. That's the amount of money that can be returned back to the investor. That's one of the highest quarters for Starbucks in the past 5 years. Now, of course, the company has a growing dividend. They're doing this on track, growing the dividend around 8% per year. I'd expect to see the same dividend growth rate in the future, and they're accomplishing that dividend growth while buying back shares ever so slightly. They're doing it just enough to offset the dilution through stock-based comp. Right now, after this quarter, Starbucks trades at a 2% free cash flow yield, a 34 PE. Historically speaking, this is around average. So overall, I really like this quarterly report, and I think the valuation's pretty good. Now, moving on from Starbucks, we get into VICI. VICI is one of my core positions. This is the only REIT I own. And a lot of people ask me, Joseph, why do you own VICI over Realty Income Corp or over all of these different REITs? The simple explanation is I believe that VICI is the most likely to outperform based on the low valuation it currently has, the high yield, and the fact that it's growing its yield faster than most other REITs. I also believe the company has more unique, valuable assets than most REITs. VICI Properties is an experiential real estate company, meaning that they invest in places where people go for experiences, not where they go to work, not where they go to live. It's places where they go for experiences. So you have a lot of concentration in Vegas, one of the best destination places in the world. But they're also investing outside of casinos and resorts. And one of the places they announced on the earnings call that they made a new investment was in this place called Canyon Ranch. Now, to me, this seems it's unrelatable. I'm not the type of person going to premier wellness ranches. I'm not doing all of this holistic yoga type of healing where you become one with the earth. That's not really my thing. So I'm not the target market of Canyon Ranch, but I do see it as an interesting investment. These wellness centers have been around for a long period of time, and they charge a lot for them. Now, to explain more about the economics of this deal going forward, we have Ed Petoniak of VICI and the owner of Canyon Ranch sitting down and explaining the details behind this deal.
So you've made an innovative new deal that's really a departure for REITs. You're deciding, Ed, that you're going to invest in your future tenant. Tell me why this is an opportunity for VICI and a little bit more about the deal.
Yeah, so when it comes to understanding real estate, you want to start with the way people interact with places. And you want to ask about commercial real estate, which has been much in the news the last 6 months. Are people going to change the way they interact with the real estate? Will it strengthen, weaken, or sustain itself? We think that wellness, life enhancement, is one of the biggest secular trends we're going to see over the next 10, 20 years. We wanted to put capital behind Canyon Ranch to give it the firepower to grow its operating platform so that together we can add more resorts to an incredible portfolio.
So there's the investment thesis on Canyon Ranch. Unlike most of VICI's investments where they simply just buy the real estate, they're actually investing in Canyon Ranch. So you're part owner of Canyon Ranch if you're part owner of VICI. And this is a departure of what they typically do. Now, there's some pros and cons of this. One of the pros is they have a lot more upside in the growth of Canyon Ranch if the company's successful. But one of the cons is the relationship is different than their typical deals. They also have more downside if this goes wrong. And I think overall, my biggest hesitancy with this deal in particular is the core competency of the management of VICI. Is this a territory where they're venturing outside of their core competency, where they're doing analysis on different types of businesses that they typically haven't worked with, and then making different types of investments? That's one area that companies can get in trouble, is if they venture too far outside of their core competency and make some bets that don't pay off. But Ed Petoniak has a history of making very good risk-adjusted return bets. So I view this also through the lens of someone that's making very diligent efforts and making very good bets for their shareholders.
That before, like Simon Properties bailing out anchor tenants to help keep their business afloat. But this is really an offensive move on your part.
Now, she just kind of glosses over that there. She mentions that there's other companies like Simon Property, the mall REIT, that bails out their tenants by buying their tenants that are going out of business. And that is a defensive acquisition. What VICI's doing is not a defensive acquisition. And I believe investors should look very negatively on defensive acquisitions. If a company's acquiring other companies, like Simon Property acquiring their tenants in order to survive, that is very defensive and it shows weakness in the business model. And what VICI's doing is nothing like that. Theirs is on the offense. They're doing this willingly, deliberately. They don't need to do this. They're doing it because they believe they'll make money.
A sense of why you wanted to look at VICI for financing. Were you not finding it from traditional sources from the banks?
Well, clearly there were financing alternatives, although they've been diminished as of late. But what I found with Ed and his team is they really took the time to understand this brand, to understand our company. And we've been engaged in this for a year. The first was the announced deal where they finance our Canyon Ranch Austin, which is under development now.
Right.
And will open in 2025. We took that relationship and we grew it, and we decided we can turn Canyon Ranch into an asset light business where it's an operating company and a brand company that's been around for 40 years, but it's more relevant today than ever before.
The owner of Canyon Ranch mentions that they're going to be operating with better capital efficiency, more asset light, and that is something that's very attractive in terms of business quality. Now, out of all of the assets that Canyon Ranch owns, all of the different pieces of real estate and property and land across the country, the biggest thing that they own, the most valuable, is their brand name, Canyon Ranch. It is an incredibly well-known name in the wellness territory. When you look at lists of the top 10 wellness centers in the US across all of the internet, Canyon Ranch is routinely mentioned as one of the top 5. It appeals to a very high-income consumer. And it sounds to me like they're going to be leveraging that brand name a lot more.
And there will be $150 million to refinance existing debt, $150 million that you can put to work acquiring other properties or making your business grow, and then the opportunity, the right to finance any future deals as well, along with the right to buy those properties in Tucson or here at Lenox, Massachusetts. What do you think the future of Canyon Ranch looks like with that kind of backing and that kind of partner?
Now, this is where we get to a big reveal here. The owner of Canyon Ranch brings up the future investment potential of VICI in their business.
Well, while I don't want to put Ed on the spot here, we have talked very openly about the scope of this. And the scope is not what we've done to date, which is $500 million. We really want to see this grow to $2 billion plus in terms of capital allocated to Canyon Ranch over the next 5, 6, 7 years. And I think that's very possible.
That was definitely not in the news release that you sent out after the closing bell. $2 billion. Is that possible?
Oh, I think it very much is. Again, if you think of wellness and life enhancement as a secular trend, when you think that there's only 2 existing resorts and soon to be a 3rd in Austin, when you think about wellness globally, whether it be North America or Europe, we absolutely think that can happen. We also think the next couple of years could be very propitious in terms of the opportunities to acquire conventional resorts and convert them to Canyon Ranches, given what is going to be the refinancing challenge that conventional resorts are going to face over the next few years, when about almost $40 billion of CMBS alone comes due on American hotels and resorts.
So Ed reveals that this $300 million investment into Canyon Ranch is likely to grow to over $2 billion over the next 5 years. And he gives some strategic insight into why they're doing this. They are well backed. They have the finances to be able to make this investment and do so without taking on a great deal of risk. And he notes that other real estate companies in this situation of owning their wellness centers are going to have a struggle if they have to refinance with the current interest rates, which is very likely to have happen. So he sees a competitive strategic advantage that they have over the competition. So I believe that this is an interesting growth path for VICI. Overall, it seems a little bit like a divergence, so there is some concern of whether or not they're going outside of their core competency, but I still believe that Ed is sticking to the sound principles of investment, looking for good risk-adjusted returns, secular trends, and owning high-quality assets. We have the big news that Blackstone is weighing offers for the Bellagio. They're selling half of their stake. And naturally, I assumed that VICI would be the buyer. In fact, I gave the odds around 60% that VICI would end up with the Bellagio. Because if there's anyone that's going to buy the Bellagio, it just seems like VICI is such a natural fit. They already own most of the Vegas Strip. Why would they not buy one of the core iconic properties in Vegas? They also have the capital to be able to make this purchase. So it seemed like all the stars were aligning for VICI to get this property. But then I listened to something on the earnings call that made me change my mind. Let me go ahead and play this bit of audio from the earnings call.
Thank you, and congratulations on Canyon Ranch. But my first question is actually on Bellagio and news around that was out around the quarter. Can you just maybe give us your view on how you would think about a transaction like that, or the appetite to do something of that nature?
Yeah, Tony, I'll start, and John and David can chime in as they wish. I want to answer that question at the level of general principles. We take great care in how we acquire, and that care manifests itself in us not attempting to buy what we can't accretively pay for. And so we evaluate every situation on the basis of, can we create value for our investors straight out of the gate? Our net lease model is a model in which the yield we get at the outset is the yield we're going to live with. I mean, we can obviously get rent escalation over time and increasing yields based on that. But we are not a category where we can go in and accept a dilutive yield going in on the basis of having an underwriting thesis of asset management that's somehow going to magically transform a dilutive yield into an accretive yield. So we are very careful and very humble in understanding what we can and can't do, and that guides our investment decision making.
So he doesn't directly answer the question, yes or no, we're going to buy Bellagio, but he basically does. He highlights the core principles of VICI, and one of them is having a continually disciplined approach in acquisitions of new properties, meaning that VICI will never buy a property if it doesn't immediately have an accretive yield. An accretive yield means that VICI makes money on their purchase on day one, meaning that when they buy the property, they're immediately creating value on the investor's behalf. A dilutive yield means that they bought a property where investors lost a little bit of money and they're hoping to make it back over time. And VICI's not willing to go down that route. They're not going to underwrite how the business might do in the next 10 years based on capital appreciation of these properties. They simply won't do it. They want to make money right away with every single transaction. Another way of looking at this is the AFFO of VICI. VICI grew their AFFO at 12% year over year last year. That is because they made accretive deals, meaning even after dilution, after raising capital, the new stuff that they bought had a yield above that dilution, so they grew their AFFO per share 12%. If VICI started buying properties like the Bellagio at a dilutive yield, that AFFO would start to decline. It wouldn't go up 12%, it would start to go down. And that's not the direction you want to go. This is like the earnings per share of a company. And this is a mistake that many companies make. Part of the reason that companies like AT&T have had such terrible total returns over the past 10 years is because they haven't understood this basic principle. They have bought things continually with dilutive yields, hoping to magically make value out of where value isn't. So VICI's not willing to go down this route. And it shows major discipline in their business model that even as good as the Bellagio is, even as amazing and elegant and impressive of a property this is, they're still not willing to buy this property if it's dilutive to the shareholder. So for me, I thought this was a great answer. If they can pick up the Bellagio at an accretive yield, I think that's great. But if the Bellagio does not fit within the parameters that VICI finds attractive for their investors, then they're better off without it. Now that's all for today's show. We'll see how this market goes. We'll see how the sell-off continues. But that's all for now. I'll see you in the next one.